Two neighbors, same block, same street, same month. Both put $20,000 into silver. One bought physical silver, one bought Pan American silver stock, ticker PAAS. 12 months later, the physical silver guy is up 150%. His $20,000 became $50,000. He is happy. He tells his friends he thinks he made the move of his life. His neighbor, the one who bought the stock, his $20,000 became nearly $69,000. Same bull market, same commodity, same 12 months. The difference between those two outcomes is not luck. It is not a hot tip. It is not insider information. It is one concept that Wall Street has been using for decades to size their trades, build their models, and collect the biggest gains in every single commodities bull market in modern history. And almost nobody in the silver community is talking about it properly. I am going to show you exactly what it is, how it works mathematically, why Pan American Silver just reported the most extraordinary numbers in its 47-year history, and why Bank of America's metals research chief just said silver could hit anywhere from $135 to $309 before the end of this year. And here's the part that should make every silver investor stop what they are doing. If Bank of America is right about silver, even just the conservative $135 target, and operating leverage does what the math says it will do at those prices, what you're about to see could be one of the most consequential frameworks for understanding where the real money gets made in this bull market. Stay with me, because this one changes how you look at everything. Let me start with a number that most silver investors have never actually looked at directly. Pan American Silver, NYSE ticker PAAS, 52-week low, 2055. That was the bottom, the floor. At the moment, the vast majority of people were sleeping on this name. The all-time high hit in January of this year, $69.99 on the NYSE, $95.39 Canadian on the TSX, the highest price in this company's entire 47-year history, from $20.55 to $69.99. That is a 240% move, not 148, 240% from the low to the all-time high in roughly 12 months. Physical silver over the same period, up approximately 150%, which is extraordinary, which beat almost every asset class on Earth. But 150% is not 240%. That gap, that 90 percentage point gap between what the metal did and what the miner did, is not an accident. It is not randomness. It is a mechanism. And it has a name. It is called operating leverage. And once I show you the actual math behind it, you will never look at a silver mining stock the same way again. Here is the simplest version of the most powerful concept in resource investing. A silver mining company has costs, workers, equipment, drilling, processing, environmental programs, administrative overhead. All of those costs are essentially fixed. They do not move when silver moves. Whether silver is at $30 an ounce or $80 an ounce or $120 an ounce, the payroll stays roughly the same. The equipment costs stay roughly the same. The mining plan stays roughly the same. The number that captures all of those fixed costs in one single figure is called AISC, all-in sustaining cost. It is the total cost to pull 1 ounce of silver out of the ground and deliver it to market. Think of it as the floor of a corridor. The ceiling of that corridor is the silver price, and everything between the floor and the ceiling is pure profit. Pan American Silver's AISC for their silver segment in the full year 2025, $13.88 per ounce. That is their floor. That is where the corridor starts. Now here is the math that Wall Street uses, and I want you to run this yourself because the numbers are devastating. 2 years ago, silver averaged around $24 to $28 per ounce. AISC across the industry was roughly $20. Profit corridor per ounce, around $4 to $8. Paper thin, barely worth celebrating. Silver today sits at roughly $82 per ounce. PAAS, AISC, $13.88. Profit corridor, over $68 per ounce. From $4 of profit per ounce to $68 of profit per ounce. Silver itself went up roughly 200% in that time, but the profit per ounce went up over 1,600%. That is what operating leverage does. Every single dollar that silver moves above the AISC floor goes directly to the bottom line. 100 cents on the dollar. The costs do not follow the price up. The entire upside goes to earnings. This is the math they teach at Goldman Sachs. It is the math that institutional resource funds are built around. And it is the precise reason that when silver moves 200%, a low-cost producer does not go up 200%. It goes up 240% or more. Now let me put this in numbers you can physically feel. Pan American Silver produced 22.8 million ounces of silver in 2025. They actually exceeded their own production guidance. At $13.88 AISC and silver averaging around $40 on a realized basis for the full year, They made roughly $26 of profit per ounce across 22.8 million ounces. That is $592 million in silver segment profit in a year where silver averaged $40. Now silver is at $82. Their 2026 AISC guidance is $15.75 to $18.25 per ounce. The profit corridor at current prices, $64 to $66 per ounce on 2026 production guidance of 25 to 27 million ounces. Do that math. 26 million ounces at $65 profit margin. That is $1.69 billion in silver segment operating profit potential in 2026, before gold, before zinc, before copper byproducts. If you had known this math in 2002 when silver was at $4.60 and Pan American Silver traded at $3 per share, a $10,000 investment would have been worth over $100,000 by the time the bull market peaked in 2011. That is the cost of not knowing what operating leverage actually does over a full cycle. And now, let me show you the secret weapon inside this company that most retail investors have never heard of, because this is the part that changes the 2026 earnings math completely, the Juanicipio mine. In September 2025, Pan American completed a $2.1 billion acquisition of MAG Silver, giving them a 44% interest in the Juanicipio mine in Zacatecas, Mexico. Most silver mines in the world cost between $15,000 and $25,000 per ounce to operate, some of the less efficient ones even higher. Juanicipio's AISC, negative $7.34 per ounce. Negative. Let that land. The gold, zinc, and lead that come out of the same rock alongside the silver are so valuable that they pay for the entire operation. And then they write Pan American a check. Every ounce of silver that comes out of Juanicipio is effectively free. Better than free. The byproducts subsidize it. When you add a mine like that to a company already producing 22 million ounces a year, here is what happens to the blended AISC. Before Juanicipio, PAAS silver segment AISC was $15.43 per ounce in Q3 2025. First full quarter with Juanicipio in the mix. Full year 2025 AISC dropped to $13.88. One mine pulled the entire company's cost per ounce down by $1.55 across 22.8 million ounces of production. That is $35 million in additional profit just from the cost reduction, just from adding one mine in its first partial year. And here's what makes 2026 different from any year this company has ever had. In 2025, Juanicipio only contributed from September through December, 4 months. In 2026, it contributes all 12 for the first time, full year, full benefit, negative AISC running all 4 quarters. CEO Michael Steinman said it directly on the earnings call. Juanicipio has been performing better than expected since the acquisition. The mine produced 2.5 million ounces of silver in those first 4 months alone and generated a $44 million dividend in December 2025 alone. That is the secret weapon, the mine that makes silver effectively free, running all 12 months in 2026, on top of a structural silver deficit, on top of war premiums, on top of vault drains, on top of $82 spot price. The math at that combination is unlike anything this company has seen in 47 years of operation. Now, let me give you the actual earnings numbers, because they are the kind of numbers that stop you mid-sentence. Full year 2025, Pan American Silver. Revenue, $3.62 billion, a company record. Their biggest revenue year in history, up 28% from 2024. Net earnings, $988 million, another record. EPS, 2.56, basic earnings per share. That is a 726% increase in earnings per share in a single year. 726%. Q4 2025 alone. Adjusted earnings, $470 million. That is 1.11 per share adjusted. Wall Street's consensus was 0.85. They beat it by 30.59%. Revenue in that single quarter, $1.18 billion. Free cash flow in Q4, $553 million in one quarter. The company's cash position at year-end, $319 billion. That is not reserves, not paper positions, cash in the bank, plus another $127 million from their Juanicipio stakes cash position. Total available liquidity, $2.069 billion, and the board declared a dividend of $0.18 per share for Q4, the third consecutive quarterly dividend increase, 29% higher than the prior year. That is a company generating so much cash, it cannot stop raising what it pays shareholders. These are not the numbers of a company that got lucky. These are the numbers of operating leverage working exactly as the math says it should when a commodity makes a structural move higher. Now here is where I want you to understand the full picture. Because there are 3 ways to invest in silver, and understanding the difference between them is as important as understanding operating leverage itself. Physical silver has one job. It is the bedrock, the insurance policy. You hold an ounce that has stored value for 5,000 years. No management team can lose it. No government permit can be revoked. No margin call can force you to sell it. Physical is the base layer, the anchor. Mining stocks are a completely different instrument. They are the amplifier. When you have high conviction that silver is heading significantly higher, and you are willing to accept the volatility that comes with a 2.54 beta instrument, miners give you the leverage that physical cannot. And that beta number matters. Beta measures how much a stock moves relative to the broader benchmark. PAAS beta, 2.54. For every 1% the benchmark moves, PAAS historically moves 2.54% in either direction. The iShares Silver Trust that holds physical silver has a beta of roughly 1.4 to 1.6. PAAS is nearly double the silver ETF's sensitivity. That is the lever. That is the gear ratio. The third vehicle, streaming companies like Wheaton Precious Metals, sit in the middle. Wheaton buys the right to purchase silver from miners at a locked-in price, currently averaging $5.75 per ounce through 2029 under existing contracts. Every dollar above $5.75 that silver trades is pure streaming profit. Less operational risk than a direct miner, but also less pure upside leverage than a direct producer like PAAS. 3 vehicles, 3 risk profiles, 3 different gear ratios on the same underlying commodity. The sophisticated capital in this space almost always holds all 3. Physical for the anchor, miners for the amplification, streamers for the middle ground. The ratio depends on conviction and the ability to hold through violent sessions. And violent sessions are part of this deal. That is the part nobody tells you loudly enough. When silver fell from $121 to $63 in the war shock on January 30th of this year, physical silver dropped roughly 48%. PAAS dropped more. The beta amplifies the downside with the same mathematical precision it amplifies the upside. There is no version of the 240% gain without accepting the sessions where the leverage cuts the other way. This is the deal the market offers. Every person in this trade knows the deal or they learn it the hard way. Now let me give you the historical proof, because the 3x multiplier I mentioned is not a prediction. It is what happened the last time this market ran. The last great silver bull market, 2002 to 2011, 9 years. Silver went from $4.60 per ounce to $48, a roughly 940% gain. One of the greatest commodity runs in modern financial history. What did Pan American silver stock do in that same 9 years? It went from roughly $3 per share to the mid-40s, over 1,000%. On a 940% move in the metal, 3.5 times the physical return, built entirely on operating leverage compounding over years. But here's the critical difference between that cycle and this one. In 2002, the structural supply deficit in silver did not exist. Industrial demand from solar panels, electric vehicles, and AI infrastructure did not exist. Chinese export restrictions, cutting global refined supply did not exist. COMEX registered inventory was not draining at 785,000 ounces per trading day. Central banks were not buying gold at record levels, signaling de-dollarization. None of that existed. All of it exists right now. Every single structural driver is present simultaneously, stacked on top of each other in a way the silver market has never seen before. And Bank of America's head of metals research, Michael Widmer, just published one of the boldest calls on Wall Street. Silver could reach $135 to $309 per ounce before the end of 2026. The $135 target comes from applying the 2011 gold to silver ratio low of 32 to 1 to current gold prices. The $309 target applies the 1980 Hunt Brothers extreme ratio of 14 to 1, both anchored in historical math. Not fantasy, history. Now run Pan American Silver's operating leverage at those numbers at $135 silver and $18 AISC. Profit corridor, $117 per ounce on 26 million ounces of production. That is over $3 billion in silver segment operating profit alone in a single year for a company with a current market cap of roughly $25 billion. At $200 silver, a price the IRGC named explicitly as the expected oil price consequence if the Strait of Hormuz conflict escalates, the numbers become almost too large to process in conventional terms. This is what Bank of America is modeling. This is what CIBC is modeling when they raised their price target to $84 from $73 just days ago on February 26th of this year. This is what Scotiabank is modeling with their outperform rating. This is what BofA analyst Lawson Winder, ranked in the top 3% of all Wall Street analysts, is communicating when he lists multiple catalysts for PAAS to move higher from current levels. The stock right now is trading around $59 to $62 on the NYSE, down from the all-time high of $69.99 hit in January. Why? Because silver pulled back from $96 to the low 80s, and the miners moved with it amplified by that 2.54 beta. But here is what did not change when the stock dropped from $70 to $60. The $319 billion in cash did not leave. The Juanicipio mine did not stop running at negative AISC. The 14% production increase for 2026 did not get canceled. The 2026 AISC guidance of 1575 to 1825 did not change. The sixth consecutive annual silver deficit did not reverse. The COMEX vault did not refill. And Bank of America did not pull back their price target. They raised it. The machine is still running at full speed. The stock price is lower. The machine is the same. Now, the company just announced something else this week that tells you exactly how the board sees the earnings picture. They renewed a share buyback program to repurchase up to 5% of outstanding stock. They are buying their own shares at current prices with $2 billion in available liquidity. That is not a company that thinks the stock is overvalued. That is a company that thinks the market is offering them a discount on their own earnings power. And the La Colorada mine exploration results released this week showed multiple new high-grade silver veins discovered at the operation. This is a mine that is already producing and already contributing to that $1.69 billion profit corridor math. New high-grade veins extend its life and potentially expand that production number in future years. Every single week that goes by, this company is adding to the structural case that the May 13 earnings report will confirm in hard numbers. Now let me be direct about the downside, because I'm not going to sell you a one-sided story. The bear case for PAAS is real, and it requires honest acknowledgement. Below $40 silver, the margin compression becomes severe. Below $30, some operations approach break-even. That is the math working in reverse. The same operating leverage that produces $68 profit per ounce at $82 silver produces near zero profit at $30 silver. The gear ratio has no bias. It amplifies in both directions. Operational risks are real. PAAS mines in Mexico, Peru, Bolivia, Argentina, Chile, Brazil, and Canada. Every one of those jurisdictions carries regulatory risk, royalty policy risk, and currency risk. Mexico specifically has seen increased resource nationalism in recent years. A permit issue or a new royalty regime in any one jurisdiction affects production from that asset directly. The Escobal mine in Guatemala has been under suspension since 2017. A government consultation process is ongoing with no timeline for restart. That mine represents potential future production that is currently offline and unpredictable in its timing. And insider activity, over the past quarter, corporate insider transactions have shown more selling than buying relative to earlier periods. That does not change the fundamental thesis, but it is data that deserves acknowledgement. These risks are real. They are why mining stocks trade at higher volatility than physical metal. They are why understanding your risk tolerance before sizing any position matters more than any analyst target. But here is the asymmetry that makes the risk-reward calculation look the way it does at current prices. The bull case requires only what is already happening to continue. The deficit running, the vault draining, Juanicipio producing at negative AISC, production growing 14%, silver holding above $60. The bear case requires new negative information to materialize, silver falling dramatically and staying down, a jurisdiction-level problem at a key mine, a management misstep on capital allocation. One case needs continuity, the other needs new problems. That is why Buffet just raised the target to $84. That is why the analyst consensus is buy with no active sell ratings. That is why Rick Rule, one of the most disciplined capital allocators in the resource sector, publicly sold roughly 80% of his physical silver to rotate into miners, saying explicitly that the earnings power repricing phase of this bull market has begun. Not because miners are safer, they are not. Because in the second phase of a commodity bull market, when earnings become visible and institutional models start re-rating multiples upward, the miners capture gains that physical cannot match. That re-rating is happening now. The May 13th earnings report is the next major confirmation point. When Q1 2026 numbers land, showing silver averaged somewhere between $80 and $96 for the entire quarter, the market will see for the first time what PAAS earns when silver runs at these levels for a full 3 months, with Juanicipio contributing every single day. The math is not complicated. At $85 average silver price in Q1, at $18 AISC, at roughly 6 million ounces of Q1 production, that is approximately $400 million in silver segment operating profit in a single quarter, before gold, before zinc, before byproduct credits from Juanicipio. For a company with a $25 billion market cap, generating $400 million in one quarter from the silver segment alone, before the rest of the business. That is what the May 13 report could show. That is the number that forces the institutional re-rating conversation. That is the moment when analysts who have been using $40 silver in their models have to update their spreadsheets with what actually happened. And when those spreadsheets get updated, price targets move, and when price targets move at institutions, allocation follows. Here's what to watch from here. 3 specific signals that will tell you whether the machine is accelerating or decelerating before any headline does. First signal, silver price trajectory in March. Every dollar silver holds above $80 adds roughly $26 million to PAAS's 2026 silver segment operating profit on an annualized basis. Every dollar, real time. If silver reclaims $90 and holds, the Q1 average moves meaningfully above $85, and the May 13 earnings number gets larger. Watch silver. It is the direct input to the PAAS earnings machine. Second signal, May 13 earnings report. That is when Q1 2026 actual realized prices, actual production numbers, and actual free cash flow land on the table in front of the entire institutional investment community. That report will either confirm or challenge every analyst target currently published. Mark that date. It is the most important single data point for PAAS between now and mid-year. Third signal, Juanicipio Q1 contribution disclosure. Pan American will break out Juanicipio's contribution specifically in the Q1 report. This will be the first full quarter of data from the negative AISC mine at elevated silver prices. That number, the per ounce realized margin at Juanicipio, is going to tell the market exactly how powerful this asset is at $80 to $90 silver. If it surprises to the upside again the way it surprised in its first partial quarter, the re-rating conversation accelerates. 3 signals. Silver price, May 13th, Juanicipio Q1 data. Watch them in sequence. Now, let me close with the line that I think puts this entire video in its proper frame. Physical silver at $82 is a 150% gain in 12 months. That is real. That is historically extraordinary. That is an achievement that the vast majority of investors on Earth did not capture. And PAAS at $60 is still up 192% from the 2055 low. After pulling back from the all-time high of $69.99, after the stock dropped with silver from $96 back to the low 80s, still up 192%. After the correction. Here's the question that actually matters for what comes next. If silver goes from $82 to $135, which is Bank of America's base case, not their aggressive case, their base case, what does operating leverage do to PAAS earnings? At $135 silver, at $18 AISC. Profit corridor, $117 per ounce on 26 million ounces. Silver segment alone, over $3 billion in operating profit for a $25 billion market cap company. I'm not telling you what silver will do. I'm not telling you what the stock will do. I am showing you what the math produces at the numbers that Bank of America's head of metals research is publicly calling for. And the math produces numbers that make the gap between $60 PAAS and the all-time high at $70 look like rounding error. The machine is running. Juanicipio is producing at negative AISC. The vault is still draining. The deficit is still running. The May 13 earnings report is coming. And Bank of America just told the world their metals research chief thinks $135 is the conservative case for silver this year. You now understand the operating leverage math that Wall Street uses. You understand why miners historically deliver 3 times the metal's return over a full bull cycle. You understand what Juanicipio does to PAAS's cost structure. And you understand what the May 13 report will show at current silver prices. Now you are in the same conversation the institutions are having. That conversation started months ago. Most retail investors are not in it yet. If you want to stay in it, in real time, with the actual data, as the numbers come in, subscribe. Because the May 13 earnings report is going to be a moment. And we are going to break it down from the inside out before anyone else finishes writing the headline. Stay sharp, know the math, and understand the machine.